Feeling uneasy about the markets? If the headlines have got you hovering over the sell button, this video is for you. In the next few minutes, I'll show you how we're adjusting portfolios right now to be defensive without going to cash. And in the end, you'll know exactly what to tweak and what to ignore. So don't freak out, sit back, relax, and let's get right into it. If you've glanced in the news lately, you know that it's noisy out there. Global growth worries, geopolitics, and yes, the latest Trump drama. It's a lot. It's a natural reaction to step aside, but here's the problem. Historically, broad markets like the S&P 500, the TSX, the MSCI World Indices, they've all averaged around 10% per year over the long term. So if you sit it out too long and you miss out on those compounding years that you'll never get back, market timing sounds smart, but sell high, buy low, it requires the perfect decisions, two of them, when to get out and then when to get back in. An acquaintance of mine nailed the sell high part by selling at the end of last year, but he hesitated on getting back into the markets. Well, the markets have recovered and they've rebounded. They just kind of ran away on him. And that's the real cost of timing, is missing out on the handful of strong days that often make the year. Well, after 20 years in the investment industry, having lived through far more catastrophic events like the 2008 financial crisis, the 2020 pandemic, and the 2022 interest rate crisis, I want to share my perspective as a certified financial planner, associate portfolio manager, and senior wealth advisor. From the asset allocation perspective, here are some simple things that you can do. Number one, tilt your equities to quality and low volatility. We've shifted towards durable, cash-generating companies and away from pure momentum and growth. Also, keep in mind, dividends can cushion drawdowns. If your stock yields, let's say 5% and prices dip, that income helps to offset the volatility. Number two, right-size your fixed income. So increase quality bonds that steady the ride. Adjust the duration so that you're not taking on more interest rate risk than you really need. Number three, add little-known asset class called private investments. They're a great addition since they don't move in lockstep with public stocks or even public bonds. That lower correlation can smooth the path and stabilize your outcome. So when I say private investments, what do I mean? I don't mean any speculative fads. I'm talking about tangible assets and private lending. Well, what is that? Private assets include real estate assets like apartments, student housing, and storage or data processing facilities. Private credit, that's a market where businesses borrow money for inventory expansion or new products, and sometimes the banks just don't have ideal terms. While it may be hard for everyday investors to participate in private investments for a variety of reasons, you can access this diversified asset class through us, all without some of the typical drawbacks like locked-in timeframes and very limited liquidity. By the way, if you haven't subscribed to our weekly Prestige Brief yet, you can do so through the link in the description below. Each week, we'll send out timely investment tips and trending strategies to help you to make smarter decisions about your investments and your retirement plan. Now, if you're the type of investor who prefers not to manage all of this on your own, if you trust a financial planner or advisor to guide you, there's even better news. You don't need to stress out about the day-to-day. Your advisor is doing that for you. Because in times like this, when headlines are noisy and markets are volatile, the most valuable assets you can have is a clear strategy managed by somebody with a lot of experience and competence. That said, one thing to keep in mind, if your advisor needs your approval for every single trade and they're managing hundreds of households, you might be call number 299 out of 300. And by the time they reach you, the opportunity may have passed or the market may have already corrected. In a discretionary program, like the one that most of our clients use, we make these portfolio adjustments in real time on your behalf. And then we report back to you with what we did and why, so that your portfolio isn't stuck waiting for return phone calls. Really, it's the difference between having someone steering the wheel in real time versus someone reacting after the fact. And well, if that sounds like the kind of partnership that you're looking for, we'd love to connect. Feel free to book a discovery call using the link below. Choose a time that works best for you. We'll go over your situation, your goals, and your questions, and we'll see if we're a fit to work together. We'll help you to live for today while planning for a better tomorrow.